Guys, welcome back to the channel. My name is Brad. This is the Firefighters Financial Toolbox. Today we're going to talk about 3 dividend ETFs that Investopedia claims are the best dividends to invest in for Q1 of 2021. Now, the way they're doing this is based on their trailing 12-month numbers. So let's take a look. SPHQ, DNL, and VIG are the best dividend ETFs for Q1, that's first quarter of 2021. Dividend ETFs are designed to invest in a basket of high dividend paying stocks. These high dividend stocks tend to be associated with companies that have a strong history of dividend increases, and that usually means bigger, less risky blue chip stocks. They may be either domestic or international and span the range of economic sectors and industries. That could be IBM, 3M, Nike, etc. Dividend ETFs are often favored by more risk-averse, income-seeking investors, i.e., people who want to invest rather than investing in individual stocks to get a basket. They are also used by investors to balance riskier investments in their portfolio. In addition to offering a regular income stream, these ETFs generally offer much lower expense ratios than dividend-focused mutual funds. Important, you guys. Remember, I always harp on fees. Fees are important. Fees are your investment killers. All right. The dividend ETFs universe is comprised of about 96 funds total, excluding inverse and leverage ETFs, as well as funds with less than $50 million in assets under management. Okay. Over the past 12 months, the top 3 ETFs have had a mixed performance relative to the S&P's total return of 9.4%. Now, you guys, this is back in October, so a little behind. The best performing dividend ETF based on performance over the past year is the Invesco S&P 500 Quality ETF. That's ticker SPHQ. In this video, we examine the top 3 best dividends below. All numbers below are as of November 2nd, 2020. So let's take a look at the SPHQ. 1 year trailing total return of 10.1%. Expense ratio of 0.15%. So 15 basis points, you guys, not too bad. Annual dividend yield is only 1.73%. Remember, these are dividend growth ETFs. More focused on growth, and they're going to have more, possibly, maybe some more extra tech. Assets under management, $2.2 billion. It's been around since 2005. SPHQ is a large cap ETF focused on U.S. growth stocks and offers investors an alternative approach to other funds that track the S&P 500. The fund tracks the High Quality Rankings Index of the S&P 500, which provides exposure to S&P 500 stocks of companies offering stable earnings and dividends with the potential for long-term growth. The index gives each company a quality score, which is calculated based on the return of equity. The top 3 holdings in this fund are Apple, Nvidia, and Procter & Gamble. So 3 big companies that dividend investors all know well. Second fund we're talking about is WisdomTree Global ex-US Quality Dividend Growth Fund. Ticker symbol DNL. So you guys, when it says global ex-US, that means global, international, excluding the US. So these are all foreign companies. It's have a 1 year trailing total return of 9.4%. Now, the expense ratio is a little high for me, 0.58%. So you're talking $58 a year on $10,000. That's a little bit expensive, but it is an international fund and those cost more. It's got a dividend yield annually of about 2.1%. Assets under management, $230.1 million. So not a huge fund. And this has been around since 2006. So let's take a look at it. DNL tracks the WisdomTree World ex-US Growth Index, which is fundamentally weight index focused on large cap equities in emerging and developed markets. Read internationals, you guys. Including dividend-paying companies, the index uses a growth score to select the top 30% of the 1,000 biggest companies by market value. The ETF uses this index to select a relatively small number of companies that offer both attractive dividends and growth. The fund's expense ratio is significantly higher than many ETFs in its category. The fund's top 3 holdings include Novo Nordisk, a Danish pharmaceutical company, British American Tobacco, a UK-based tobacco manufacturer, and Fortescue Metals Group. I've not heard of that. And Australian-based iron and ore exploration and production company. So you guys, this is giving you dividends from the international market. Number 3 on their list is one that I personally hold. That's Vanguard Dividend Appreciation ETF, ticker symbol VIG. It's got a 1-year trailing return of 8.2%. This one has the lowest expense ratio of the 3, you guys, at 0.06% or 6 basis points. Annual dividend yield of 1.78%. About $47 billion in assets under management, and this one too has been around since 2006. VIG is a large cap fund targeting growth equities through the NASDAQ U.S. Dividend Achievers Select Index. The roughly 188 stock index trades stocks which have increased their dividends for at least 10 consecutive years. I like that, making the fund a strong option for investors with a long-term horizon. You guys, how much do I preach about investing long-term? The fund's top 3 holdings are Microsoft, Walmart, and Procter & Gamble. So 3 big companies that everybody knows, right? So what do you guys think of the 3? Do you guys hold any of these funds? As I said, I hold VIG. I've never actually heard of DNL, but I know that Invesco has a lot of good other funds. I've heard of SPHD. I have not heard of the SPHQ, but you guys, here's the thing on this. This is an article written, as I said, back in November. But here's the thing you need to remember. It's looking at what happened last year. And you cannot decide what your investment choices are based on what happened last year, because every year is different, right? I feel like it's a good idea to have some of these. I like the fact that these are dividend growth companies. Now, if you're a purely dividend investor, you see that the dividends are a little bit lower than some of the higher dividend yielding ETFs out there. But it gives you the offer of the companies, as well as them growing their dividend. You have appreciation of the stock prices individually, which is going to make the price of the ETF rise with it over time as well. So it gives you a good option that way. What do you guys think? Would you go with any of these 3? Or if not, let me know in the comments which ones you feel are going to perform better in 2021. All right, you guys, I hope you got something out of this. If you do me a favor, drop me a like. It really helps the algorithm. If you're not already subscribed, you know the deal. Hit the button, ring the bell. You get notified every time I make a video. All right, we'll see you. Thanks.